Hey guys, welcome to this video. Don't forget to get my free training underneath. I'm Will Sebastian, the founder of Be Profitable Trading Academy. So today we're going to go over the AUD dollar. I'm sure there's many of you who've been looking at my posts asking me about it. I've covered it on some streams and some posts, and I will tag my previous video post underneath. But really, we had something quite interesting. I had quite a few members of my academy ask me about this, and really they referred to the most recent price move. We saw something similar across lots of US pairs. Okay, mainly it came about as you had those inflationary reports and the comments from the Fed. You know, around the 10th is when you really started to rally because people said, you know what, I don't want to buy dollars anymore. Perhaps the interest rates that the Federal Reserve are going to implement aren't going to be so high for so long. Therefore, my money's not best spent perhaps in that area. So we had a significant rally. I mean, from yesterday to where we rallied from, you know, the 10th to the 28th, you had sort of three red candles, okay, or two red candles mainly. And that significant strength, which you can still see persists at the moment, has brought this particular currency pair and other dollar pairs alike up a considerable way. And what was really interesting about this was what I mentioned before. I said that to get the data you really want, or get the kind of bias you want about future long entries, you have to use what you can see previously, because it becomes absolutely no coincidence when the market repeats again. It comes to the same area, people have the same bias, and they say, all right, well, we preferred that for long entries before, so perhaps we're going to do it again. That's what makes the basis for probabilities in the market, and the probability essentially of the position you take going the way you want, because of course, to make money, that's something you have to focus on heavily. So we had a nice text short zone when we actually came up to the short side, because we got the long entry. If you took it long, you should be out. Okay, I took it lightly long. Many other people did. And if you just look at the trajectory, you know, you can see it's a little bit of an extreme way to draw it. But if you just look, you can see that you've actually come down for a considerable amount of time in a downtrend. Okay. You've had your consecutive lower lows. You still need your next to affirm it completely for three low lows. But there's considerable lower highs. So one can simply surmise that this is downtrending over time. So therefore, if you're looking for a long-term short entry in the market, you would want to do it in line with that, because swimming with the market rather than against the tide can be a lot easier. So what were the significant parts of this? Well, clearly what you can see here is your earliest 20 moving average. That is always a really good gauge for reshorting a strong trend. Now, it's not the case that every time you hit your 20 MA, life is going to be wonderful and the price is just going to come back the way you want. That's absolutely not what happens a lot of the time. But you can see within this strong downtrend, that has been the case several times, okay? At least for the last three times, you've touched onto it or more or less around it, and you've come straight back away. Now, it's not really, you know, the point of those is not to be some magic theory where you touch them and you bounce off, like an electric eel stinging something with its tentacle and it flying away. That's not the case. All you're really trying to do is gauge where really is ideal for me to reshort this market within that long-term downtrend. Okay, because if you look at this, you can see you're coming down and down and down and down and down. Okay, just like this. Now, you haven't quite had a significant lower low at this point. Okay, you've had one here and beforehand. And like I said, to affirm it, you would probably want to be ending up down here, which I wouldn't be shocked if you do eventually. And likely that's going to come in line with this key level of price action for long entries. If you stretch the whole way, could be a bit extreme, but could occur. That came about in COVID times, so it's a little bit rash. But nonetheless, from the back of that, you've come down for years and years and years anyway, so it wouldn't completely shock me. But coming back to what I was saying about touching your key lower MAs, you can see you've actually come straight above this, okay? And your stock oscillator has come way up as well. So like I said, it's completely not the case that you hit it every time and you bounce away, because you haven't here. The better thing really to focus on is those key price action levels, okay? Those key areas where you've seen price bounce away before, or you've seen rejection, because they are going to feed the bias, okay? They're going to feed your bias for renewed short entries. In other words, the reason why you would consider that a short. And if it looks a bit messy on lower time frames, don't forget, you can always put them up slightly. And again, you'll find it's no coincidence that when you come into really, really strong areas of contention, especially at these key moving averages, you get those rejections. And that's why I called it short around this level on the rebound, on the move up from down here. Okay, just like there was no coincidence with this rejection, you get the same thing when you touch onto this candle that brought you down. Okay, and you'll also notice if you look back, the same thing occurs many, many times over. Okay, it's a contentious area. So that's why it was ideal to short. Now, because of that strong market sentiment now changing the market, really what you would look to do is rebuy on falls. If you had it short now, you could consider exiting or locking in gains because you've got a good, more or less a fair drop there. Okay, I wouldn't be shocked if you get back to something like this, your 6595 area and this area of local key support. You can see clearly you're far off your lowest MA, so I would probably presume really they will catch up. If you do end up getting down here, perhaps with risk averse longs, that wouldn't shock me either, and that would probably be ideal to buy, because your goal as a trader is to buy dips and short when the market comes up. Or in other words, buy the dips, exit the dips, on pushes up, reshort the market, because we all know the majority of markets come in this oscillation. That's all you can see here, up, down, up, down, up, down. It's absolutely no different going forward. Okay, you want to trade it in a similar way where you're buying on market drops, okay, and you're looking to short as the market comes up higher. So you could consider locking in gains. If you're a swing trader, you may want to exit slightly lower. But if you're someone who's looking to get long, I wouldn't be shocked really if you find your MAs creep up a bit and your stock oscillator creeps down about more or less 3/4 or halfway and starts to go along like that. It wouldn't shock me at all. And really, you'd be using that long-term bias of the dollar now changing its sentiment, changing the sentiment around it. People are saying, okay, well, we don't want dollars anymore. We want to buy alternative currencies, and pulling up higher. But absolutely, you had a really key short zone. And in my opinion, you shouldn't be buying into these areas of resistance. Okay, if you want to get long, you've got to have some kind of a fall. Okay, and on your weekly as well, you've got really strong support lower. If you get there soon, it's questionable given that strong sentiment. But if you're looking to short it down, you could perhaps do it on lower time frames as you come down. That's the wrong button. You could do it if you sort of pop up back to these low moving averages for a continued fall. But I would just be careful doing it. If you're going to do that, I would do it fairly lightly. So to sum up, I wouldn't really buy it until you get a considerable fall. I think at the earliest you might be able to lightly buy it 6594, 95. But probably for risk averse traders, people a bit less sure, 6547 is ideal for me at least. Looking to the upside and potential shorts is slightly different. You've got your first layer, as I labeled a minute ago, for shorts, okay, and your resistance over here. I would say I wouldn't be shocked if you get nearer your 40 MA over here, okay, and you get another bump in the road there, 684. I'd probably say ideally this level is quite good for me. I prefer it. Lots of contention, lots of price action, lots of rejection. 0.6955 would be ideal. You can see this 40 MA I was just talking about. If it does become the case that you slightly drip, that would be ideal. And that's probably what I think will occur. But you'll need another good push to get there, okay? And I think that will probably take a minute. And you might find that you stop or bounce off something like your 68320 area. So you've got some US news. You had some today. Okay, I believe it was GDP or something like that, wasn't it? It was gross domestic product annualized for, and you had Germany CPI. So things going on in the world, bit of US news. And then tomorrow you've got consumer price spending or consumer consumption, I believe, something like that. So we'll be looking towards what the Fed says. So thanks for watching as always, guys. Hope that helps. If it does, like, share, comment, subscribe. My free training, of course, as always, is underneath this video. It will help you immensely. Don't forget to take it. It's free. See you in the next video. See you there.